Ben has written a lot on the housing market for years. We have him in our office fairly regularly to give us updates. And, we've got these, these B20 guidelines that are going to basically affect housing affordability. They brought forward a lot of housing consumption in the last year. And I think principally what people are most concerned about are where house prices are going. But tell the crowd, what some of the risks are and how deep the housing price correction can go on a near-term basis.
So the GTA, we're talking about the GTA plus, we're talking about Hamilton, Kitchener, Barrie, because, you have people that drive until you qualify. It's, there's the Toronto refugees that go there. And that's why when you talk about correlation between those centers and Toronto, it's basically 95% correlation. So it's not just the GTA, it's much more than that. Same goes for Vancouver. Now, listen, until 2016, when it comes to the GTA, I was able to explain everything. I have all those models that try to explain the housing market, in terms of demographics, demand, supply, and all my models were able to explain most of it. Something happened in 2016 that all my brilliant models were not able to explain. And if I cannot explain something, it must be bad. So I'm sure it was speculations. I'm sure it was flipping. I'm saying something bad happened in 2016 in the GTA and the first half of 2017, the way it happened in 2015 in Vancouver. And usually when you have something like this happening and activity goes up by 20-25%, as you know, in 2016 and the first half of 2017, usually gravity takes place. And that's exactly what happened in 2017. And exactly at this point, we have seen also the provincial government introducing the 16-point program that most of it really is not relevant because 14 out of the 16 they simply cannot implement, so it's not important. This is the correction. The correction is clearly gravity plus policy plus changes by OSFI. So we are talking about a situation in which the market is adjusting. And what we are doing now in the GTA, we are simply undoing 2016 and the first half of 2017. That's what we are doing. Not more than that. We are simply undoing it. So talk about numbers. I don't know. I think that when I talk to developers of new construction in low-rise, we are seeing a very interesting situation. Demand is definitely slower than it used to be. They are not used to it. But the small developers, mid-sized developers, they can simply stop. And that's what they're doing. So we are seeing supply going down, actually. And the only companies that continue to build, those are the large ones that have, an engine that has to continue to go because they have a stable labor force, and they are actually lowering prices. The others actually lower prices, and then they stop releasing, so supply is going down. That will be a mechanism that actually will ease the pain. In the resale market, we're seeing more supply, less demand. The market is adjusting. Can it go another 5-7% down? Absolutely, it can in the low end of the low rise, single family over the next year. But I think that the vast majority of the decline is already there. We'll see a little bit more, and that's it. This is not a free fall by any stretch of the imagination. I will not be surprised if this market will soften a little bit, especially with foreign investors slowing down. But I believe that with B20, a bit increase in interest rates, and of course the gravity forces, we will see some softening also in the high rise over the next year, year and a half. But this is just the short-term story. The long-term story is that this city is becoming more and more expensive. This is just a slowdown in a trajectory. And this, in the GTA, it's all about policy. We simply don't have enough supply. Toronto is an island when it comes to real estate because of policies. We don't have land because of policies. The Places to Grow Act, introduced in 2006, is the main reason why prices in the GTA went up. All the other is the gravy, low interest rates, demographics, we know the story. But the lack of supply is definitely there, and policies to date are making the situation even worse. I'm talking about the changes in the Ontario Municipal Board. I'm talking about rent control. This will make the situation even worse. So yes, from a short-term perspective, the next year or two, am I going to invest in real estate? Maybe not. But from a long-term perspective, if you believe that this city is unaffordable now, you wait. I think that rent control is a major, major issue. And when I say rent control, I'm not saying that rent control is a bad thing. Although, you know, when I wrote about it, I quoted a Swedish economist, a left-wing economist, a Swedish economist saying, rent control is the best way to destroy a city, maybe besides bombing. And you know what? He's right. This is not a smart policy. And I was begging the government to basically go with inflation +2, namely rent increase of inflation +2. By doing so, you protect the tenants, but also you allow builders to build purpose-built rental that we need desperately. And now we don't have it, and that's why supply will be a major issue. So if we are able to revise that, that will be great. If we are able to revise the decision about the Ontario Municipal Board, that will be great. Much more important is simply releasing more land, or at least accelerating the process in which land is being released to the market.
And I know you wanted GTA, but Vancouver was a bit of an example for us. And when Benny's talking about what changed in 2016, we know policies in Vancouver changed. Some of that hot money probably migrated, and post changes in Ontario, people are looking at other cities like Montreal. But if you look at what we've seen over the number of years is all this macroprudential tightening at the federal level, some at the provinces. So it's all demand management, and to the extent it's a supply challenge. We don't have enough work on the supply side. To Benny's point, we need the municipalities to start getting more builder-friendly, if you will, release more supply. And I suspect, unless we see more supply, Toronto prices will firm this year.
People talk about foreign investors. I'm not interested. I don't think it's important. I think it's the media. It's not really important. It's like 5% of the market. Domestic money is important, but that's new immigrants. So taxing foreign investors is not a big deal, in my opinion. I think that much more important is domestic investors in the condo space. Today, if you include principal payments, and I will be releasing a paper on that soon, no less than 50% of those domestic investors in condos, 50%, half of them, are already in negative cash flow. They're losing money on this investment. So the question is why? Take a GIC, get 2%. So maybe they think like me, that from a long-term perspective, that will continue to go up, and that will be a good investment, and their kids will be able to afford living in this city. So that's, if you want to understand the real estate market today, you must understand the psyche of condo investors. They account for 50% of the market at this point. 50%. And if they start selling, if they stop buying, this market will go down. So that's the key wild card, if you will.
Well, I actually agree with a lot of Benny's conclusions. I just totally disagree on how we get there. First of all, okay, on the supply issue, we always hear supply. Last year, we had over 220,000 starts. Vancouver starts are at close to all-time highs. Toronto starts are very, very high. It takes a while to actually complete some of these units.
Think of it. Since 2000, for every unit decline in what we call low-rise, we had 1 unit increase in high-rise. So we're basically building less and less and less low-rise, single-detached, and building more and more apartments, which means that 1-to-1, the ratio is 1-to-1, basically. You are replacing an expensive unit, a house, with an apartment, less expensive. In a funny way, this actually limited the price inflation in the GTA. Can you imagine if we didn't have this substitution? So we're definitely changing. I totally agree that the issue is not supply. The issue is supply given preferences. Namely, everybody here still wants to live in a house as opposed to an apartment. And people haven't changed this way of thinking. Also, we haven't graduated to a situation in which if you are 35 years old, you are married, you have 2 kids, and you are renting, nothing is wrong with you. We haven't graduated to this, like in London, like in New York, like in Berlin. So the only way to solve this crisis is to release the rental solution. We have to change the way people think, but much more important, we have to have supply, and with rent control, you will not have the supply.
I don't see supply as being a major challenge. I'd echo what Doug said. Everyone talks about how the U.S. went through an overbuilding phase from 2001 through about 2006. They were averaging something like 2 million or 2.1 million housing starts per year. Well, if you just do a crude approximation to Canada, that's the same as 210,000 or so. And we've been doing that not just for the past 5 or 6 years, but you X out the financial crisis of 08, 09, and it's almost 12 to 15 years. And now part of that is making up for an underbuild that we had in the 90s. But I think now we've entered a phase where supply on the national level is starting to outstrip what underlying demand growth is. And that puts us in a dangerous position, in my view.
You know, when there is a recession, the housing market will correct. My point about the supply and the fact that it's tight is from a long-term perspective. It's not the next year or 2 or 3, because things can happen, and they're happening now. So am I investing in real estate now? Maybe not. But if you ask me if I'm investing in real estate for the next 10, 15 years, absolutely in the GTA. So from a long-term perspective, I think that Toronto can go places, although totally agree that if tomorrow there is a recession, the housing market definitely will correct, and I will be buying into this correction. In terms of who is more vulnerable, I don't think that higher interest rates will lead to a wave of defaults like in the US. I think it will lead to a situation in which more money will be going towards debt financing, less towards consumption, and potentially that can be recessionary, and that can lead to higher unemployment and therefore higher delinquency rates. So it will be in the back door. It's not the impact of higher interest rates, at least not the immediate impact. So clearly, if it's a very severe recession, then we'll feel it, and the risk is actually a recession coming from the US, so that's definitely a risk facing the housing market in Canada.
1/3 of Canadians are renters. And I'm going to do something I never do, which is I'm going to tell you a personal anecdote, which is not how we run economic analysis. I went to go see 3 houses this month, 3 rentals, and I entered into a bidding war for each one on the day of. A bidding war for a rental. That's terrifying to me. So 1/3 of Canadians, renters, okay? Number 2, do you know what the number 2 determinant of fertility rates are? House prices. Number 1 is female education. Number 2, house prices. Because if you cannot afford...
I thought one might have been NHL playoff season, but...
Well, my son is 6 months old. It's actually the Raptors. So number 1 determinant, female education. Number 2, house prices. If you cannot afford another bedroom, you are not having more children. So I think we need to think a little bit more broadly about what the long-term ramifications of this situation are. And if we are heading towards a situation that is being described here, that there will be offshoots that affect our broader economy on a longer term run than just what's going to happen to 5 or 10% moving forward.
There is an increased sensitivity to higher rates. There is no question about it. As a society, we're definitely more sensitive to the risk of higher interest rates. Low interest rates, when they went down, they really didn't impact the market in any significant way, because we have a generation of Canadians that never experienced high or even rising interest rates. For them, those extremely low mortgage rates, it was not as exciting, yeah? It's like, interest rates, it's like... being in a relationship. In the first few weeks, you're so excited you cannot breathe. But if after 5 years you cannot breathe, you have asthma. Yeah?